Yeah. It's highly unregulated, and that's the problem. So we don't know where the problems are.
Later this week, Liquidators will attempt to unravel the mystery behind a former hospitality baron's spectacular fall as they begin examinations in the federal court as to how Jon Adgemis accrued $1.8 billion in debt. It's expected the role of private credit or non-bank lenders will be cast into the spotlight and highlight growing risks facing the economy. Chief Business Correspondent Ian Verrender joined us to explain further. Hi Ian, it is a fascinating story you've written up for ABC News. Who was Jon Adgemis and how did he build a $280 million property empire?
Well, Jon Adgemis was a real high-rolling corporate advisor for KPMG for many years and worked on the BHP and Billiton merger and then basically cut himself free. I think he seemed to like the Hemis hospitality empire and he tried to emulate that. And so he went out on his own around about 2014, 2015 and started to put together this hotel portfolio. How
did he accrue so much debt?
Well, he borrowed some money early on and he was in debt to with Bruce Gordon, the head of Win TV, the owner of Win TV, and also to Jan Cameron, who was the brains behind Kathmandu, but they all fell out over unpaid debts. He then started to buy hotel properties and revalue them. So, you know, buy something for, say, $30 million and suddenly, before the transaction was even completed, it would be revalued by a lot more, $70, $80 million. And then use that supposed capital that was excess to borrow more money, and he built the portfolio that way. The problem here is that he is in debt to the tune of $1.8 billion. So he's the equal highest bankrupt in Australian history. Alan Bond is the other one, so they neck and neck. But the problem is, say, $1.8 billion worth of debt with hotels that only cost $280 million.
And so when and how did it all unravel?
Well, it unravelled, I guess, after COVID, but that was when he was really in the midst of buying. It was a buying frenzy that he went through during that period in the early 2020s. And I think the plan was to list the entity on the stock market and make his money back that way. But a lot of the properties that he bought, he was going to renovate, so he'd closed a lot of them down for renovations, and some of them were just never completed.
Ian, the money didn't come from traditional banks, did it?
No, and this is I guess an important point here, that property developers have had trouble raising money from traditional sources, particularly after the Hayne Royal Commission tightened up lending regulations. And so there's been this growth of what's known as private credit in America, across Europe and in Australia as well. It's a banking system where you don't have to have all the documentation that a bank would require, but you can still borrow the money. The catch is that it comes at a very high interest rate, up to 20% sometimes if you're a borrower. And you might ask, well, why would anybody want to pay that kind of interest? Well, you can't get it anywhere else. And as a property developer, you can't get it because there's enormous lags between when you buy a building site, when you build the building, between then and when you actually start selling off either the units or the finished commercial property.
And private credit is something that the regulator, ASIC, is quite concerned about, warning that it does pose risks to the economy. As recently as a fortnight or so ago, the Reserve Bank too is concerned.
Yeah, it's highly unregulated, and that's the problem. So we don't know where the problems are. There's a lack of...
you see them.
That's right, and there's a lack of transparency here, both from the point of view of the banking system as a whole, and that's what the Reserve Bank is worried about, the financial system. But if you're a lender into this, if you put money into one of these private credit funds, you don't really know exactly who you're lending to. So it's a higher risk lending, which is why you're getting a better return. It's been very, attractive to particularly people running self-managed super funds because, it looks to be a very safe kind of investment. You're told if things go belly up, you've at least got a first mortgage here. So you've got access, you've got security over real estate here.
And are the risks greater today than they were, say, a year ago because we are on the cusp of a property downturn?
You'd have to think so, because when you get a property downturn, if it's a residential property that you put your money into, well, clearly the developer can't get the kind of end sale price that they were banking on, and so that means that their profit margins are going to be squeezed. The cash flow is going to be squeezed, and they might not make it through. And do you really have a first mortgage over these properties? And oftentimes that's turned out to be not the case.
Ian Verrender, good to speak to you.
Thanks, Kirsten.